Do you want to know how the Canadian tax system works? Because I promise you, it is much simpler than you think. Whether you're a recent grad just trying to find your footing when it comes to adulting, or you're new to Canada and learning about the Canadian tax system for the first time, this video will help explain how income tax in Canada works, including tax rates and tax brackets, credits and deductions, how to get a tax refund, and most importantly, how to file your taxes the most efficient way possible before the deadline. A big thank you to this video's sponsor, TurboTax. TurboTax is Canada's #1 tax solution trusted by millions of Canadians for over 20 years. TurboTax's intuitive, smart solutions gets to know you, helps you find every tax deduction you deserve, and double checks your tax return to help make sure it's right. Not only that, TurboTax has a team of tax experts, as in real people who have an average of 10 years experience, available and ready with expert answers. Whether you do your taxes yourself, with some help, or work directly with one of their experts, TurboTax makes tax season quick and easy. You can learn more about them at turbotax.intuit.ca, which I'll link to right here, and I'll also include a link in the description of this video. TurboTax has also provided me with some voucher codes to use. So check out the description box for more details to learn how you can enter to win one of these codes to use TurboTax for free. Okay, so let's start by talking about who is actually required to file income taxes in Canada in the first place. So as per the Income Tax Act, every resident and deemed resident in Canada is required to pay income taxes on their worldwide income. And a person can be an individual like you or me, or it can also be a corporation or a trust. Now, you may be wondering, why would I pay Canadian income tax on income that I earned outside of Canada? The answer is simple. To discourage Canadian residents from storing and earning money in a low tax rate country like the Cayman Islands to avoid paying their fair share of taxes. That's called tax evasion, and that's illegal. With that said, for example, if you worked in Australia because you were there for a summer internship and then you had to pay Australian income tax on that money that you earned, you can claim a foreign tax credit on your tax return. So you won't be taxed in Australia and Canada, aka double taxed. Similarly, if you're a non-resident of Canada, then you only pay tax on the money that you earn while you live in Canada. And likely there is a foreign tax credit in your home country, so you can avoid that double taxation as well. So what taxes are you paying on your income exactly? Well, there are two types of tax. There's federal tax and provincial tax. Everyone pays the exact same federal income tax rates, but you only pay the provincial tax rates of your home province. So someone living in Ontario would pay federal taxes plus Ontario taxes, and someone in British Columbia would be paying federal taxes and BC taxes. Now, you can play around with different scenarios if you like by testing out TurboTax's tax calculator, but just remember the numbers they provide are just estimates. Now, this is important to know because some provinces have more favorable tax rates than others. For instance, the top 5 provinces and territories with the lowest tax rates in Canada include Alberta, Saskatchewan, Northwest Territories, Yukon, and Nunavut. And the top 5 provinces with the highest tax rates include New Brunswick, Newfoundland and Labrador, Quebec, Prince Edward Island, and Manitoba. In other words, if you had a salary job that paid you $100,000 per year, you would have a higher take-home pay or net income if you lived in Alberta compared to New Brunswick, meaning you would get to keep a lot more of your paycheck if you lived in Alberta. Now let's move on to tax brackets. In Canada, we have what's called a progressive tax system. What this means is people with a lower income pay an overall lower tax rate than people with a higher income. In other words, the more income you earn, the higher your overall tax rate will be. Now, I see a lot of people talk online about how it's unfair that higher income earners have to pay higher taxes. But what you need to understand is this progressive tax system was introduced to help reduce poverty and inequality and narrow the increasing gap between the rich and the poor. Moreover, although you are paying a higher tax rate than someone with a lower income, you're still taking home an overall higher income than them. One false belief that I still sometimes see online is the idea that you shouldn't strive to earn a higher income because the tax you'll owe on it will wipe out the increase in income anyway. So it's better to keep your income on the lower to middle side to avoid paying higher taxes. That is not true at all. You should always strive to earn more money because ultimately you will take home more money. Let me show you an example to show you what I mean. Okay, let's pretend you live in Ontario and you have a salary of $84,000. Well, after taxes, your net income or after-tax income is $62,400. But what if your boss wanted to give you a $1,000 raise? Is it worth it? Yes, it is. Even though you are paying a little bit more in tax, remember your after-tax income is still higher. It is $63,000 $43,086. That's an increase of $686. Did you want to say no to an extra $686? I don't think so. So how a progressive tax system works is you get taxed different rates on different levels of income. This is what's known as tax brackets. Let me show you an example. Let's say you live in Ontario and you earn $60,000 per year. Federally, you would pay a 15% tax on your first $50,197. And then on the remaining $9,803 of income that falls into the next tax bracket, you would pay a higher tax rate of 20.5%. For your Ontario taxes, you would pay 5.05% on your first $46,226. And then on the remaining $13,774 of income, you would pay 9.15%. So when people say that they are in a high tax bracket, what they mean is they have enough income to push them into those top tier federal and provincial tax rates. But that's actually not the whole story. And I see a lot of other videos kind of miss this really important element, which is the basic personal amount. This is a federal and provincial non-refundable tax credit that all individuals can claim. Now it's the same amount federally, but it does differ per province. The basic personal amount provides a full reduction in federal and provincial tax to individuals with taxable income that is below the basic personal amount threshold. In other words, if you earn less than the threshold, you don't owe any tax. Now, if you were to combine your top federal and provincial tax rates, so using our example, 20.5% federally and 9.15% provincially, you would get your marginal tax rate. As you can see, 20.5% plus 9.15% equals 29.65%. 29.65% is your marginal tax rate. Your marginal tax rate is the amount of tax that you would pay on each additional dollar of income that you earned over the previous tax bracket. In other words, if instead of earning $60,000 per year, you earned $62,000 per year, since your marginal tax rate didn't change, that additional $2,000 would still be taxed at your marginal tax rate, which is 29.65%. But that's not the only tax rate that's really important to understand. There's also your average tax rate. This percentage shows you how much total tax you're paying on all of your income. Now, as you can see using TurboTax's tax calculator, with your $60,000 per year salary, your average tax rate would be 16.69%. This percentage is calculated by taking the total amount you have to pay and dividing it by your total income. Another thing that I want to mention real quick is just that the tax rates that I just mentioned, those are tax rates specifically for employment income and self-employment income. But there is very different tax treatment when it comes to income that you earn on your investments. For example, if you earn interest income, such as, something you earn on a savings account, a GIC, or a bond, that income is taxed at your full marginal tax rate. If you earn capital gains from buying and selling a security for a profit. For example, if you bought a stock for $100 and then sold it for $150 a few months later, only 50% of that gain, so $25 because the full gain is $50, that is taxed at your full marginal tax rate. The other 50%, the other $25, completely tax-free. You can also reduce your capital gains by subtracting any capital losses when you sell a security for a loss. And then there are dividends. Dividends are a little bit more complex depending on if they are eligible or non-eligible dividends, but in general, you can use tax credits to reduce the amount of tax that you owe when you earn dividends. Speaking of tax credits, let's talk about tax credits and tax deductions that you can use to legally reduce your tax bill. So when it comes to tax credits, there are refundable and non-refundable tax credits. Refundable tax credits allow you to reduce your tax bill even if you end up with a negative amount. For example, let's say you use enough refundable tax credits to reduce your tax bill to negative $500. That means the government actually owes you $500 because you paid the government $500 more in taxes than you should have throughout the course of the year. Some examples of refundable tax credits include medical expenses and also the Canada Training Credit. As you may guess, non-refundable tax credits only help you reduce your tax bill to zero. Once you hit zero, you hit your limit, you're done, you won't get more refund. Now, some examples of non-refundable tax credits you can use include the caregiver amount, disability amount, your tuition, education, and textbook amounts, interest paid on your student loan, digital news subscriptions, pension income amount, medical expenses, donations and gifts, volunteer firefighters amount, search and rescue volunteers amount, and home accessibility expenses. And lastly, there are tax deductions. Now, tax deductions are very similar to non-refundable tax credits in that they help you get a tax refund, but they do work very differently. Whereas tax credits help you reduce your tax bill, tax deductions lower the amount of income that is subject to tax. Now, in general, tax deductions do provide greater tax savings compared to tax credits, but ultimately you want to use both. And one of the best tax deductions available to Canadians is your registered retirement savings plan, your RSP contributions. So whenever you make a contribution to your RRSP, you can deduct that amount from your taxable income. For example, if you earned $60,000 but made a $10,000 RRSP contribution, you could deduct that $10,000 on your tax return, reducing your taxable income to $50,000. And the best part is you can save those contributions for deductions into the future. So for example, maybe you've contributed to your RRSP, but you're not actually in a very high tax bracket and don't really need the deduction. You can save that contribution until you are, at a later date in a much higher tax bracket and could really use that tax deduction. You do not need to deduct that contribution in the same tax year that you made it. You can actually defer it indefinitely. Moreover, you also get a tax deduction for any of your contributions to your work's pension or group RRSP. There are literally hundreds of different tax credits and deductions available. But honestly, this is why people use tax solutions like TurboTax Full Service. So they can get a tax expert with years of experience to take a look at what kind of unique tax credits and deductions you're eligible for and apply them to your tax return to reduce your tax liability and get you a tax refund, making it quick and easy to maximize the amount of money that you get back. Which leads me to the final part of this video, filing your taxes. For the 2022 tax year, the deadline to file and pay your taxes is April 30th, 2023. However, because that day actually falls on a Sunday, you get until the next business day, which is May 1st, 2023. And if you're self-employed, the deadline to file your taxes is June 15th, 2023. However, you still have to pay your tax bill by that May 1st date. Otherwise, it'll be considered a late payment and you'll be charged interest and penalties. Since this was a lot of information, I want to leave you with some action steps so you can get your taxes done right after this video. First, confirm your tax filing deadline and gather all of your necessary documents. There's actually a free checklist you can download from TurboTax to help you make sure you don't miss anything. You can find it here and I'll also link to it in the description for this video. Next, choose a method to file your taxes. This is likely not a surprise, but 92% of tax returns are filed electronically because it is much easier and more convenient. And TurboTax has a solution for every tax situation imaginable. Small business owners and those who started a side hustle would benefit from using TurboTax Self-Employed. And I actually helped my sister who started her self-employed business not too long ago file her taxes with this solution last year. And I actually made a video about how to file your taxes if you're self-employed, so make sure to check that out after this. If you want to hand off your taxes this year, then definitely check out TurboTax Live Full Service. So you can meet with an expert while they do your taxes for you. It's super easy to use. Once you sign up, you're matched with the best expert for your unique situation, and they'll do your taxes for you start to finish while you meet with them. If you have all of your documents ready, TurboTax experts can prepare and file for you in as little as a day. TurboTax has you covered and their experts can help you navigate your unique situation even if you had a big life change, started a business or a side hustle, or investment income or rental property income. Now, I actually tested this out myself a few years ago and I thought it was super helpful, really easy to use, and honestly significantly more affordable than hiring an independent tax accountant. And also really good news, if you were 25 years old or younger, you can actually use any of TurboTax's solutions for free. Thank you again to TurboTax for sponsoring this video. You can learn more about them and check them out at turbotax.intuit.ca. I will link to them here and of course in the caption comments below, and consider them if you are looking for a tax solution to file your taxes this year. And also a reminder, I have 10 voucher codes to use TurboTax for free. I will include details in the description box. Well, that's it for me. I hope you learned a little something. Thank you so much for watching and I'll see you in my next video.